There's a lot of pent-up demand for the gold metal. Even if we get a small move into the gold space by the generalist investor in North America, things will just go crazy. It's a relatively small amount of capital. $208 million is not the usual billion or $2 billion that you'd see for a mining project. And so that brings us into the snack bracket. And if we think about that $3,000 gold price, we get to $750 million of NAV. And we're only mining to about 150 meters deep with our current pits. And again, I would highlight this is just one project in our portfolio.
Alright, today we're having a chat with Hugh Agro, the CEO of Revival Gold. You've released some very exciting PEA results for your Mercur Gold Project.
It's a wonderful week here, great results, and really happy to be with you to talk about them.
Yeah, perhaps we can dive into your results. Can you take us along what the numbers are looking like, what you have actually done in this PEA, what type of level of detail you've gone through here, and just take us through the results?
For sure. So headline numbers, 95 to 105,000 ounces of gold per year from the Mercur Project in Utah, United States. Average production of 95,000 ounces a year over 10-year mine life. All-in sustaining cost for the project is about $1,360 an ounce. Relative to today's gold price, just over $3,100 an ounce. That's a very healthy margin. The NPV on the project, even at a conservative $2,175 gold price, is $294 million. All of this in the market cap of Revival Gold, currently about $50 million US dollars, and that's excluding any credit for our Bear Track Arnett project in Idaho, another 4.6 million ounces of gold, and another over $200 million of NAV. So lots to be excited about here.
100%. And of course the gold prices you've used are very conservative. Your base case of $2,175, even your upside case of $3,000 looks to be conservative compared to the current gold prices. And still we're seeing amazing results here with an IRR of 57% at $3,000 gold.
Yeah, and I think that's one of the real advantages for investors coming into development companies like Revival Gold in good locations where we don't have high geopolitical risk. We've got a ton of leverage to the metal directly through the ounces we have in the ground, but also indirectly through the potential for expansion of through exploration, and of course the elevating gold price. So, the one way to put this is that right now Revival Gold is trading at $8 per ounce in the ground, compared to the current gold price. That's 1/350th of the value of that gold. And so as you think about it, it's a lot of leverage, and that's the reason why investors want to at least put part of their portfolio into a diversified selection of trusted, well-located gold developers like Revival.
Yeah, I think that's a great overview, Hugh, and definitely you are very attractively priced, let's say, in the market currently. Here's some more results. Perhaps you can take us along what actually the study looked at doing with your resource. Here we see 66 million megatons at 0.6 grams a ton. What is really the process of getting that gold out of the ground? What are your recoveries going to look like? What is the capex of getting that mine back into production? Because of course it's a gold restart project. What does it look like?
Yeah, so this is a good summary slide to be attending to here. The resource that will be exploited as part of our development plan is that 66 tons at 0.6 grams of gold per ton. We will mine that through an open pit truck and shovel operation with 150-ton, short-ton trucks, and then crush that material in a 3-stage crush down to half an inch. Load it up on pads, put solution on the pads to pull the gold out of the rock, and then we take the gold out of the solution through an ADR gold processing facility. Now, this is a relatively conventional means of mining and processing gold ores. We will get an average recovery of 75%, which is actually quite high, and it speaks to the metallurgical characteristics of the rock we're working with here. And we'll be producing that 95,000 ounces on average over the life of 10 years for the mine. The capital cost at $208 million reflects our working capital needs as well as our payments on leases with respect to the equipment fleet. So it's an all-encompassing capital. It works out to about $219 per ounce produced, which is extremely favorable relative to our peers at much higher levels of capital intensity. That's a function, of course, of this being a brownfield site that is with existing infrastructure, power line, paved road, offices, water. All of those things make for a lower capital intensity. The operating cost, cash operating cost, just over $1,200 an ounce, gives us a lot of margin. The all-in sustaining cost, which reflects additional sustaining capital in relation to stripping and in relation to road works and so on, it takes us up to about $1,360 an ounce. Again, very strong margins here relative to that long-term gold price that we've forecast out, the economics and the current spot price today. The NAV, again, $294 million at a 5% discount rate. And if we think about that $3,000 gold price you were referencing earlier, we get to $750 million of NAV. And again, I would highlight this is just one project in our portfolio, and we're talking about a company with a market cap today, so a current valuation of about $50 million US. A lot of upside.
Great overview there, Hugh. Thank you for taking us along there. And you have this slide in your presentation where you compare your all-in sustaining costs that you've outlined here in this PEA to your peers in the industry. And perhaps you can explain to us how is it that this asset is able to get such a low all-in sustaining cost on the curve compared to your peers, compared to majors currently producing gold. What makes it such a low cost asset?
The main difference here is grade. We're running at 0.6 grams per ton gold. A lot of our peers run at much lower grades, and so that's a huge advantage for us. The second thing is that we are 100% gold. This is not a gold equivalent situation. So the recovery of those byproduct metals like copper and silver generally tends to be lower, and so in this process, we enjoy the benefit of strong recoveries, pure gold. The other thing I'd point to is the site location. We are 1 hour's drive from a major city, Salt Lake. That means that we can access people more easily. We don't have to build a construction camp. We don't have to have people on rotation and look after their transportation and their room and board and so on, as some of these operations do. And finally, it just gives us better access to equipment. And so if you think about the details of operating a mine, we don't have to worry about having big inventories of equipment because the suppliers are an hour's drive away. So that's a huge advantage for us. There are other things around the topography, the setup for the mining operation itself. We're only mining to about 150 meters deep with our current pits. And so that makes for an efficient, relatively low-cost operation.
All right, makes complete sense. In your press release, you referenced that the PEA basically advised to do some extra drilling on your project to reclassify some of your resources from inferred to indicated. Perhaps you can take us along what that is all about, roughly what we're looking at there, what the target is, and those great figures.
We've got about 3,000 meters of drilling into the project resource already. That's 280 kilometers of drilling, 3,000 drill holes. So there's a lot of drilling in this deposit. We've already got over 50% of it in the indicated category of resources, but we still have some more inferred material. And in order to convert that material to the higher confidence indicated and measured categories, we'll want to do more drilling still. And in addition to that, we'll also want to do some more metallurgical test work. So those are really the next steps for us as we progress the project from a technical point of view. And the good thing about all this is we can do that while we're moving through the permitting steps. It's a pretty efficient setup here. We already have a clear idea of what we need to do in terms of the permitting and in terms of the technical programs. And remember, this is a site that's already successfully produced gold in the past, We've got lots of data and insight and operational experience to bring to bear here, and proven approaches as to operating on the site. So these things lower risk and will allow us to move more quickly through the steps of PFS, FS, and permitting to construction.
Makes sense, and we'll touch base on that permitting more in just a second. Quickly want to take you towards this drilling again. I think you have this slide. Really, this low-cost drilling that you're outlining here, is that because of two factors, because of the shallow resource, as well as that you're using RC drilling instead of diamond drilling? Is that why the cost of this coming program will be relatively modest?
Yeah, I think that's it. First of all, there's not in a relative scheme of things, because we've got so much drilling in the deposit already, we don't have really a lot more to do in that regard, and it's relatively shallow, and we can use RC as opposed to core drilling. And core drilling is about 3 times more expensive than RC, so we will have to do some of that, but we can cover off most of the bases with RC drilling. For your audience, the main difference from a practical point of view is that RC drilling is something you want to reserve for the drier climates, the drier deposits. And when you start to get into wet areas with high water tables, that's when you want to use the core drilling. We're in this advantage situation where we can get away with RC drilling for much of our drilling. We still will need to do some core drilling in order to get metallurgical sample material, but this will really keep our costs down as we move towards construction shovel turning.
Makes sense. And what do you think roughly are the timelines to start infill drilling this project?
We'd like to get at it this summer. We've got some work to do to get through our technical report, which will need to be filed in the next month or so here. We're also working on developing up the plans and the alternatives for us in terms of follow-up technical work. And in the meantime, we want to get out and tell the story on the very exciting news here, and just what it means in terms of shareholder value. We have a lot of eyeballs on Revival Gold, both corporate and financial, and there's a lot of information for those interested parties to digest. We want to get through that over the next month, 2 or 3, but our plans would be to be back in drilling, and of course we want to move as quickly as we can towards production.
Great. And transitioning towards the permitting, you already started referencing it. Perhaps you can take us along. How would that roughly look like for this project? Of course, you're located on private land. What that means, perhaps also. What would roughly the timelines be for that?
We and our consultants are looking at 2 years to permit this project. The main aspects of that will be around cultural survey work and wildlife survey work. The fortunate thing is, as you point out, we're on private land, so we deal through a state process. That's Dogum that runs that process in the state of Utah. And we don't have any endangered species that certainly that we're aware of. We've got the past mining history that's been successfully operated. So a lot of the survey work has already been done. We'll need to add to that survey work as part of our re-permitting of the site. But we have a lot of information already to go on. And between the fact that we've got little water and we're on private ground with no endangered species or fish or other things to be super concerned about here, this is going to be a pretty straightforward process. In fact, the cultural survey work that we'll do as part of the re-permitting of the site is really just directed at the historic mining that's been going on here. We don't have any native burial sites or community activity that we need to catalog. It's the odd tin cup from the miners who followed before us.
And I think you referenced something interesting there to quickly dive a bit deeper into. You referenced re-permitting. Of course, it has been a past-producing mine. It's a type of gold mine restart project. Does that really make a difference in the permitting process that it has already had a mining history in the past? Or is it roughly all the same?
It makes a huge difference. The first reason is that the site is already disturbed, so we know what's on the site, and we have the benefits of all the data that's been collected on the site already, the survey work, the test work. Plus, we have the operating experience to say that it can be done responsibly. And, we all want to make sure that when we go into a situation like this, we can do it responsibly. We're only temporarily using the land. We go in, we take out the resources, and then we put the project back to a usable other purposes. And what is so beneficial about having following in the footsteps of a past successful operation is that we can point to how it can be done successfully. We can point to the examples of how those sites can be brought back to be reused for other things. In this case, that other thing is to go back in and do more mining. But in future years, that site could easily be used as a recreational site. It could be used for a housing site. It could be used for for sporting. We do already have a lot of mountain bikers and dirt bikers that use some of the land around us. So there's lots of follow-on uses for this land, and we want to make sure that we look after it. And having that example of responsible operation in the past gives us a lot of confidence that we can do that successfully again.
Excellent. Thanks for the overview there. Quickly, last main topic I want to dive into regarding the PEA before we start zooming a bit out and start looking at the firm-wide level. Of course, the initial capital cost, capital expenditures you've outlined in your PEA of $208 million. Here is a quick makeup on this slide of what that roughly constitutes out of. Can you give us a reference of what kind of the rationale is behind this, potentially developing this mine yourself and raising this capital? How would you go about that? What are the options available to you?
The nice thing about this project being in the United States is that we don't have geopolitical risk to contend with as you might have in some African countries or South American countries or elsewhere. There are a lot of lending institutions that want to lend into domestic U.S. mining opportunities. So that gives us more options. The other thing is it's a relatively small amount of capital. $208 million is not the usual billion or $2 billion that you'd see for a mining project. And so that brings us into the snack bracket, if I can put it that way, for a lot more providers of capital. It gives us more options for capital. The other thing I'd say generally about Revival Gold is we've been very careful not to sell forward our streams, royalty opportunities around this project to third parties. And so we have those kinds of things that we can bring out of the cupboard when we need to bring in layers of funding across the balance sheet. Lastly, there'll be an equity component to funding that capital item, no question about that. And here we would, I think, lean on our shareholder base, some 40-50% institutional and corporate ownership that is very interested in backing our team to continue to move towards free cash flow. And as we de-risk the project, I think we make ourselves even more attractive to even wider pools of equity capital. So I see this as a very doable funding hurdle for us. It's still a couple years out, but we'll start the preparations, even this year in dialogue with lending institutions, royalty providers, streamer providers, convertible providers, and equity providers, and get ourselves lined up. And it's really important to make sure that we understand the objectives of those entities and that we bring their EAs, their engineers along to have comfort with the work that we are doing as part of our development and engineering planning.
Thanks, Hugh. 100%. This figures, of course, it pales in comparison to the billions other mines would need to raise, and definitely in that way would be quite feasible. Quickly want to take the viewers along to this slide you have in your presentation, slide 31, where you compare your price to NAV to some of your peers. Of course, it looks very attractive from this perspective, a price to NAV of 0.1, and that's compared to the conservative gold price you use in your PEAs. Perhaps we can quickly talk about, I think the value is very clear. What are some of the options available to you to really try to re-rate on a P to NAV basis now?
It's an interesting phenomena of the markets generally right now that the big cap names are seeing more momentum and therefore more capital chasing them. We are a small cap, and I think that liquidity and lack of size impairs our ability to access capital cheaply. As the bigger you are, the cheaper the capital. And so, we do think about that, and we think about our alternatives to bring in strategic partners, financial partners, or do corporate M&A that would allow us to vault higher in the ranks in terms of liquidity and share capitalization. All, of course, with a view to maximizing the outcome for our own shareholders as we think about those opportunities. That is an avenue that we look at. And I think when you're trading as cheaply as we are trading right now, that is a very interesting opportunity for many of our peers, larger peers, looking down at Revival Gold trading so cheaply. But we're going to keep our eyes firmly on the goal of continuing as an independent company here. And so we'll focus our efforts on getting the message out on the value in the stock, and we'll focus on the longer-term pools of capital out there that are looking for good value. And that's what I say on the outset here, is that we've got to spend some time over the next month or two getting out to visit with folks around this opportunity. It's just too good, and we think there's lots of value for investors to enjoy as upside here before we do anything corporately. What this graph shows you, though, is that there's very little downside to our story based on what we have and where we sit here with the gold price today.
Yeah, great overview there. And of course, when a story is really undervalued or attractively valued, let's say, it always is a struggle as an investor. When is that re-rate going to happen? No one really knows, except that it should happen in the future. You also have this slide where you compare the average price per ounce in the ground. Of course, also disclaimer to the viewers at home, I do own some Revival stock. Definitely, so I am biased in that sense, but I believe the figure is $8 per ounce in the ground, with the current gold price of 3,150 as we record, roughly speaking. That is, of course, a tremendous value opportunity, even with some projects having been purchased in the $35 to $50 per ounce in the ground range.
Yeah, look, we have there are other peers, Banyan and Troilus are good examples of peers that might be trading at lower values still than Revival Gold. But what I would say about our project is that it's uniquely phased. It's got unique brownfield characteristics that make it lower capital intensity. It's got unique data available from past successful operation that we can apply to the future. And so that really, I think, makes us stand out above many of our peers, even those that may be even more undervalued than us. But I do encourage investors to do their homework, stay diversified, and participate in this sector, because it is extremely compelling on any trend or any metric, relative or absolute. 100%.
Great words of advice there. Staying diversified, doing your own due diligence. Of course, switching quickly to the macro market, where we have seen this insane upward trajectory in the gold price, truly outstanding. Juniors have been lagging a little. What is your general sense on gold currently, and also the juniors? What should we expect for the next maybe 12 to 24 months? How does the macro cycle really look like currently?
Well, look, I'll offer my opinion, and that's really all it is, based on 35 years in the gold business. What's happened, I think, over the last 15 years is that the market for gold has moved east to China. It's not just central bank buying that's underpinning the move in gold, but it's also retail buying in the Asian countries in particular. We're seeing life insurance companies in Asia now permitted to buy gold, and so that big voluminous jurisdiction in the world has found the metal and is driving the price. We haven't seen it show up yet in generalist retail appetite in North America. In fact, I think the latest stats I've seen is that the generalist investor is probably sitting about 1% weight in gold equities and gold metal relative to what we would traditionally see as market weight being 2 or 3 times that. So I think even if we get a small move into the gold space by the generalist investor in North America, things will just go crazy. There is just not enough gold to go around. A lot of it's already moved over to the Asian markets and other parts of the world. In our own case in Canada here, our central bank owns no gold. We sold out of our gold reserves a number of years ago, and so you can think about that as lost opportunity, lost diversification. And at some point, I think central banks that are short gold are going to want to catch up as well. So there's a lot of pent-up demand for the gold metal as a result of the broadening of the universe of buyers in that metal, the increasing population, industrialization, and that I think that has soon to come home to rest. In the meantime, there's this constant focus on momentum and the larger market cap stories, which I believe is starting to roll over as we think about value. Certainly in North America, the S&P 500, the NASDAQ were off the peaks there, and investors are looking for other opportunities where there's good value and long-term potential. And gold's had that historic 3,000-year, 5,000-year history of being a part of man's everyday use, and I don't think that's going to change anytime soon.
Great overview, Hugh. Thank you there. And of course, a very exciting time to be advancing a gold company like yours with that precious metal that everyone is looking for in the ground. Perhaps we can end off this interview quickly with talking about next steps. What is really what we should be looking out for the next couple of months for Revival Gold?
Well, we'll be working diligently to get our technical report out as part of the requirements around the PEA. There'll be a lot of data in there and information that interested investors will want to pick through. We'll have that filed within the next month and a half. We're also working on crafting together the plans, the drilling alternatives, the exploration opportunities, and of course getting out and marketing our PEA results. This is one of the first calls we've had on these results, but we want to get out and do a lot more of that. We've got folks in our electronic data room. We need to work them through the information and get folks out to site that are interested in that. So there's a bunch of that work that has to go on. I think in the next month or two, we'll be able to more definitively pin the timing and the steps for the rest of this year. We do want to get out there and do some more drilling. There are some exploration opportunities we want to pursue. We'll get underway with our cultural survey work to start the permitting efforts here in the next month or two as well. Lots going on. It's a busy team and a busy time.
Great. Hugh, thank you so much for your time. Really appreciate it.